All right, welcome back. This 3 minutes to go for the pre-open session. It's going to be a flat start and then a volatile day. I think we can say that with some amount of certainty. There is another new development which we want to kind of address, and this is with regards to a NSE circular which has come through on the options side. Now, what the NSE-based circular basically is saying is that the do not exercise facility has been scrapped, on the option side. Now, let me just quickly explain this with an example, and then we'll get Rajesh Baheti of Cross Seas Capital. Is actually with us. Rajesh, good morning. But just to explain to our viewers what this means with a simple example. I mean, suppose, someone is holding stock X the stock X finishes at, say, 2,001 rupees on the day of expiry. And one holds, say, a 2,000 call option, a call option with a 2,000 strike. 250 shares is the lot size. Lot size is 250. So on the day of expiry, you basically end in the money. Now, what the option circular, the NSE circular says that you have to take delivery. That's what the circular says, which means that you have to come up with 5 lakh rupees, which is nothing but 250 into 2,000. You have to come up with 5 lakh rupees to buy those 250 shares at 2,000 rupees. You no longer have the option of not exercising your call. And of course, the question is, what if you don't have 5 lakh rupees to exercise? How disruptive is this going to be? Rajesh, good morning again. Did I explain the problem or the issue correctly? If not, please clarify. And is this going to be a big issue on the option side of things? Go on.
So, good morning, Prashant. Absolutely. Now, you pick up any textbook on options. Any theory on options tells you that the seller receives premium and has an obligation to either buy or deliver the share, but the buyer who pays the premium has the right to exercise that option. What the NSE has done is it's removed that right of the buyer and converted it into an obligation. So to that extent, I think the theory on option trading that we've all been used to has been turned on its head. Having said that, I think they've announced it in advance. So while it is going to be disruptive for the buyers, but I think the wiser thing to do for them would be to square off their position and not wait till the last second, because now they know that that right no longer exists. It has been converted into an obligation.
Do we have any data, Rajesh, which, how many, what's the percentage which just goes unexercised?
So it's not a large proportion. Obviously, if you're going to make money on the contract, for example, if the example that you just explained, that a 2,000 rupee contract, instead of, let's say, ending 1 rupee in the money, it ends 20 rupees in the money. You're making 1%. So you're not going to give that up, and you're likely to exercise or square off that position using another option or the futures. Where the problem might occur is if a security is in a ban period. Whenever that happens, the liquidity just simply dries up, and not allowing traders to trade that security at all because it's in the ban period will make that issue very complicated, because till the last second the traders will not be able to square off that position. So one of the things that NSE could do is that on the last day of the settlement, the ban period or the penalties for trading that security should not apply.
In any case, Rajesh, brokers kind of discourage options buying close to expiry, right?
So, close to expiry, I could have bought it on the first day of the contract, and I could be holding that option, because it's very difficult for a broker to then figure out now how many people are holding options which become close to at the money at the time of expiry, because I could have bought a 2,000 rupee call option, taking your example, when the price was 1,800. And it so happens that it has gone to 2001 by the time the contract is expired. So it was way out of the money when I bought it, but it has become in the money. The problem is, the theory teaches us that the most an option buyer can lose is his premium. Now here, the obligation can take the losses much higher.
Correct. And this goes into effect from this expiry, Rajesh?
Yeah.
From this expiry. Okay. All right.
Yes.
So that's an important, I mean, it's all. You're saying the impact will not be that much. The percentage which goes unexercised would be relatively small, logically speaking. But now that this is there, one needs to be aware, right?
Absolutely, because 90% of all the trades are anyway in indices which are cash settled. So the problem is only in stock options.
Stock options.
You've got to be careful. That's about it, and not wait till the last second.
All right, Rajesh, thank you very much for that. Appreciate you joining in, and good speaking with you. So, that's the circular and the impact, as Rajesh explained. Do not wait till the last second to square off your stock options. Do it well in advance. I'm assuming that most of you do it, but I think the information now should be widely circulated, and I think brokers, intermediaries, etc., will do that over the coming days. Because this does kind of raise the stakes if you let the option go unexercised, which is now, as the NSE circular says, not possible.
Prashant, just one worry, some of the stock options are not very liquid. So if you do away with this, then it's a bit of an issue. Because you'll have to close your position, and if it's not very liquid, then how do you close your position? So that's the other point out there, on stock options in particular.
I wonder if we'll get some sort of clarity, or maybe, a bigger window for the market to digest this. I think we'll have to watch the developments quite carefully around this one. But the pre-open rates have come through. So before we move to our next guest, quick check on the screen. About a 0.5% decline, 0.4% to be precise. That's what the pre-open Nifty is indicating. Where is the pressure? HDFC, Hindalco, Asian Paints, HDFC Bank, IndusInd Bank, and even Reliance. So it's pretty mixed, at least as of now. That's what we're getting on the market in the pre-open. But let's stick to one sector where there's been a lot of activity, hectic action in terms of ordering, a lot of positive sentiment as well. And we're talking about the power space. We have Murtaza Arsiwala, director at Kotak Institutional Equities, joining in to make sense of this. Among a lot of the sectors that he tracks, I think this is one of them as well. Murtaza, good morning. Great to have you on the show as always. Now, Vivek was telling us about some of your top picks just yesterday, and I think a lot of them are coming in from the power transmission space, stocks like KEC, I think even Kalpataru. So tell us, when we're looking at the power opportunity, what makes you more optimistic on transmission than the other segments? What's the big kicker here?
Essentially, if you look at the transmission segment, it's been less competitive. If you look at, when we look at transmission projects which are being competitively bid, on average, you've had about, 3 or 4 bidders per project. So it's not that competitive, number one. Number two, you've also got, if you look at the return profile for some of the projects that were previously bid and have now got commissioned, the return profiles are pretty attractive as well, well above what the regulated returns were in the case of Power Grid. And that's what keeps us optimistic. It's sort of, in a way, a second-order derivative to play all of the investment that's going in the renewable space in the country, the large targets that the government has.
Okay, so I'm going to dive straight in because we'll be running into market opening as well. You've got a buy, I think, on Power Grid, also on Kalpataru Power and on KEC International. So how are you cutting this up in order of priority and why between these 3 stocks?
So let me just clarify up front. KEC and Kalpataru is something that my colleague in the capital goods space covers. So I'll stick with Power Grid. But specifically on Power Grid, essentially the way we're thinking of it is, there are 2 segments of investment. One is the conventional transmission strengthening schemes, which continue. And, over a period of time, given the large asset base that Power Grid's now built up, you were seeing some moderation in growth. You've got a new leg up in growth essentially coming in because of the investment that's now going to happen for all the transmission infrastructure that you need for the renewable capacity base, that we're targeting to set up. So you've got this second leg of growth, which should help the company accelerate on growth. Healthy return profile, not so competitive. Out of the 16 projects that were awarded in FY23 so far, as many as 12 have been won by Power Grid. So, the competitive intensity is not pretty large. Power Grid continues to dominate. Return profile is good, and you've got a large upcoming opportunity. Even if all of the renewable targets are not met, even if we, let's say, assume a 50% sort of success ratio, that will still keep Power Grid in pretty good state.
Got that. Murtuza, what on the generators as well? Because a lot does seem to be changing, at least on the face of it. Even the guys who are running on imported coal, they have been allowed a pass-through now, at least in the peak summer months. It seems to be far more transparent and fair. And then you have the biggies like NTPC also moving towards the renewable transmission, towards the renewable transition. Would you be looking at generators at all? And what are the triggers to watch out for there? If not now, perhaps later?
So we are constructive on NTPC as well. There is this big transition that they are looking to make on the renewable space. But like I highlighted previously, the transmission is a second order derivative on renewable. Our only concern so far on the renewable space has been that it's far more, the competitive intensity is far more, and the return profiles that we've seen are not as attractive. I wouldn't say they're absent, but they're not as attractive as what we're seeing on the transmission side, and which is why we're finding the power grid argument slightly stronger. Coming specifically to your question on imported coal capacities and the pass-through, the pass-through element that's been provided is more temporary in nature. It's for the summer months. We saw that happen last year as well. It was applicable to up to December, and then from Jan to March, again, you've not had that pass-through. You're sort of still living, each quarter at a time as far as you're looking at some of those imported coal-based capacities. And you've not been able to resolve, while we've been talking about it for several sort of quarters now, we've not had a permanent resolution to the issue on imported coal-based capacities. That's something that the market would look forward to. Until that really comes through, I would still sort of hold back on the imported coal-based capacities.
Okay, so then finally, let me ask you the simple question. Is there a dark horse out there in the power sector? I don't know if you track the exchanges as well. I mean, IEX, everyone's quite excited about higher volumes as we get into peak summer. But what do you think would be that, one shining star from the power space next 12 months?
Well, given my own sort of stock picking style, I'd still go with the power grid, then look out for the dark horse, which could sort of substantially surprise us. But nothing that I see in the radar immediately.
Those are, good to hear your thoughts on this space, but you should track real estate as well. Are you still looking at that space?
Absolutely.
Yesterday Shobha was under pressure. I'm not sure whether or not you'll track it as a coverage, but what is your updated target price and any view on the stock?
We're constructive. Our target price is around 830. The business performance has been good. What's weighing on the stock is various sort of regulatory concerns. The most recent being the IT rate that the company did announce yesterday, and that's weighing on the stock. Previously, we had the promoter chairman sort of take a non-executive role. Prior to that, you had certain issues with sort of local authorities, and those are the issues that are weighing down. So it's more regulatory issues that are weighing on the stock than the underlying business performance or the fundamentals of fair valuation.
So fundamentally, it's looking up, but we'll have to see how these other aspects play out. Thanks so much, Murtuza, for joining in and discussing the main theme, the power stocks, as well as giving us a quick word on Shobha as well. Well, we have Sudarshan who's back with us for the 9:10 call. Sudarshan, what's the call?
Well, Dabur, wait patiently for the Nifty to show a trend, and Dabur is a buy with a stop under 530.
Mitesh, what about you?
I'll go with the buy on SRF, keep a stop below 2350, target of 2450 can be looked at.
Okay, got that. Thank you, gentlemen. Let's quickly move on and talk about some of the brokerage calls that we're getting on GAIL after that big price hike that came through yesterday. Sonal?
Well, yes, largely positive commentary is what the brokerages are making of this tariff hike. Citi has a buy rating with a target price of 125 rupees a share. They say that integrated tariff hike should put to rest the skepticism that the street has around any regulatory headwinds that could be there for GAIL. Management presented a positive outlook across all the businesses. So volume recovery and steady growth is what they're expecting in the transmission business going forward. Jefferies has a hold rating, but they see a 17% EBITDA increase in FY24 FY24, with part of the benefit offset by the higher operating costs which could come by. But LPG profitability will be impacted by sharp fall in international prices that we have seen. Morgan Stanley has an overweight rating. They feel that it will be a 2,000 crore addition in terms of revenues because of the tariff hike, and 14% or 12% upside to street estimates for FY24 and FY25 for their EPS. They see further triggers from chemical price increases and cheaper gas also, which will support margins for the company. JP Morgan has a neutral rating. The tariff hike and lower spot LNG prices, according to the brokerage, is a positive, but earnings will continue to remain volatile, especially in their marketing segment. So that is something that they'll be tracking. Motilal Oswal has a target price of 147. They increase EBITDA estimates to 13,400 crore rupees versus 11,600 crore rupees for FY24 that they had earlier. And lower LNG prices and the uptick in the petchem segment is something which will aid earnings for GAIL as well. So all in all, positive commentary coming in.
All right. Thanks very much, Sonal, for that. By the way, we have, the managements of IGL and MGL joining in at 9:30 this morning. That's a conversation you don't want to miss. We also have the management of Gas Authority of India joining us at 10 a.m. This morning on Bazaar. So it's a power-packed lineup. All right. Asian Paints is also going to be most likely in focus. Mangalam is back with us to tell us why. Mangalam, hi, morning.
Good morning. So it's an interesting note which is coming from Jeffrey. Jeffrey says that the margin outlook for Asian Paints is improving. Even because of the decline in raw material prices, the companies may pass on these price hikes to consumers, and as a result of which, rather price cuts to consumers, as a result of which demand looks increasing as well, and the share price may rally. But this is not a positive note. They're saying that this rally must be used to sell into, primarily because 12 months from here, we have Grasim's foray into the paint sector as well. And Asian Paints currently trading at 56 times 24 price to earnings is higher than its pre-COVID 5-year average of 45 times as well. So they have an underperform rating on the stock with a target price which has been cut from 2570 to 2500 rupees. Telling you that the rallies must be used to sell.
All right. Mangalam, thanks very much for that. You know, the market opening is upon us, so let's just quickly take a look at what the first rates are going to throw our way. 54 points lower on the Nifty in the pre-open, and the Sensex is lower as well. The rupee started stronger, 82.38 compared to 82.66 yesterday. The dollar is much weaker, of course, 0.75% sell-off on the US dollar index yesterday, and I think that's kind of giving a bit of a lift to most Asian currencies, emerging market currencies, etc. You know, the big thing is, if at some point during the day we get confirmation that the U.S. regulators have a more expansive view of helping and backstopping bank deposits in the U.S., suddenly the sentiment changes on a dime and things start to look very, very different. For now, we've got open at 17,079, 17,083. So it is lower as the pre-open indicated by about 66 odd points. That's about 0.5%, not even 0.5% or so. The Sensex is down 230 points. We are on the Bank Nifty down 0.4%, 39,820. When it's a uniform 0.4% cut across most indices at this point in the day. So that's what we have. Let me just quickly take a look at the Nifty names and see if there is anything very large which is playing out. I don't think so. Hindalco is down 1.33%. Adani is down 1.33%. Asian Paints is down 1.25%. These are the only three 1% plus cuts on the Nifty index. And on the way up, you've got Hero MotoCorp, L&T, and Sun Pharma, which are up about 0.4% as well. So it's quiet, on the Nifty. Although on the Nifty index, it shows up with a 79-80 point cut. Surabhi.
Well, beyond the index for the time being, in terms of news, I'm looking at Nazara because they've done the small acquisitions, just less than $2 million. But the stock is quite active, up about 3% last I checked. Yeah, 2.5% right now. Then a clutch of companies that have won orders, GR Infra Projects, HG Infra, NBCC's won some orders between 1% and 3%, depending on which ones you're looking at. Chalet Hotels has acquired a couple of properties, including, some of you might be familiar with this one, Duke's Retreat, which is right here in Khandala. So that's the stock up about 2%. HAL under pressure as expected because of the OFS. And the OFS was at about, I think, a 6% discount. So there's an adjustment that seems to be happening in any case. A little bit of a overhang of that stake sale from the government. Other than that, in terms of major volumes, Adani, Green, Total Gas, some of these stocks are up. By the way, TVS Electric was up about 17-18% yesterday. It again starts out with big volumes and a 4% bump up. Interesting move on this stock. Actually, Adani Transmission is also up. Some of the Adani stocks have basically started off on the positive side. That's what we are getting. In terms of mid-cap action, overall, the index is down about 0.3%. Nifty is still holding to that cut of about 75 points. Bank Nifty is also down in sync, a cut of about 0.5% on the Bank Nifty. Reliance is facing pressure. We had one good day on Reliance this week, but no follow-through. 1% down on Reliance as we start off. TCS, ITC, Infosys, these are some of the other heavy stocks, big stocks, which are trending down. So I guess, Nigel, for the time being, we've got this 0.5% decline at the start. Now let's see, I guess, where it goes.
Well, that's right. Survey Coromandalam International as well, they have announced the entry into specialty and industrial chemical segment. They're going to be investing close to under 1,000 crores. I think for starters, that was up close to under 2%, and that's holding well in the green. A couple of other movers today. Shobha got smacked yesterday, particularly towards the end of trade. It's trying to pull back a little bit, clawing back up close to around 2.5% odd. Murtuza of Kotak, he just said that fundamentally they're quite positive on the stock. So that's opened up well in the green. Now currently building on those gains, up close to around 3% odd. GAIL is pulled back. Yesterday in late hour, well, there was some bit of buying that we saw. But maybe, it was already factored in because the street was already working with that kind of a hike. So that's pulled back close to around 1.5%. We'll try to get in the management in a short while from now. And HAL is down a good 5% odd. For the week itself, HAL is now down close to around 11%. It was down 5% in this week. And now post the announcement of the OFS, it's down another 5% odd. The Nifty is moving gradually lower. But as we said earlier today, it needs to hold on to the 17,050 odd mark. If that's the case, then it's pretty good news. The Nifty Bank actually is not doing that badly. It's holding on to that crucial 39,600 odd mark. Prashant.
Nigel, Sobha is coming up a little bit. We were just discussing that with Murtuza earlier. It was a big loser yesterday, and I was making that point, is back to pre-COVID levels. Although Murtuza did highlight, beyond just what happened yesterday with those searches, etc., there are some other concerns, although underlying fundamentals are looking good. So there's a bit of a lift there. Nazara is up about 3.33%. It's coming up on decent volumes, so we should put that up. Policy Bazaar lost 2%. It's coming up 2%. So just some reversals of yesterday's move. And GR Infra that, listed the recent, not that recent, but fairly recent infrastructure company, 4% higher, 1,002 on GR Infra. There was great enthusiasm when the company came to the market, but has done poorly since. FACT, NBCC, Chennai Petro are some of the others which are doing quite well. The Adani Group companies are a bit mixed, but Green, Total Gas and Transmission are up between 2 and 5%. So, they're coming up with some of the largest volumes right now at this point in time. TVS Electronics is the other one, 4% gain, 363, and it's got volumes on it. So that's why I'm making a quick mention of it. Reliance is down 1%. It's a very tentative start, but it's a large name and it's got weight. Vedanta is down 1%. Asian Paints we already highlighted. GAIL is down 1.4%, settling down a little bit now. Life insurance was all doing very well yesterday. I can spot ICICI Pru, which is seeing a bit of a pullback. It's down 1.5%. Campus Shoes is another one which is down about 2.25%. Let's volumes pick up because they're still a little low. 90 full point cut on the Nifty. We're at about 17,062 on the index at this point in time. This Thursday open, 5 minutes into market open. We have Manish Sontalia who's joining us now to take some questions. Is of course with Motilal Oswal Financial Services. Manish, great to have you with us here. Thank you very much for your time. How are things looking, Manish? The waters have been muddied a little bit with all that is happening globally, although markets here have corrected very aggressively as compared to global markets, even though the problems have not emanated from here. What's your perspective on things now?
Yeah, so I think incrementally, inflation has become a bigger concern now. And obviously, corporate defaults, bank defaults, they are a more worrying point from an Indian market point of view as well, the global market. So I think, markets are not going anywhere. I would believe that they are broadly going to be sideways, let's say plus minus 500 points on the Nifty is what the markets will see over the next 6-9 months. I think it all boils down to how the earnings shape up, and value style will be in greater focus than growth style.
Hi, Manish. Always a pleasure having you on the show. So, that's quite a statement. 500 points plus minus, and that's how we spend the year. And I completely get where that's coming from, right? Even before these global issues and this turbulence came upon us, we were busy discussing how the third quarter earnings season is seeing downgrades and corporate earnings aren't exactly burning up the charts. So how do you see the domestic setup play out? X of whatever's happening around the world, whether it is inflation, monsoon, and could that become, again, a bigger concern for the market?
Yeah, so I think, it boils down to where the earnings growth are going to come from and how the valuations on those particular sectors shape up. So having said that, I think if you look at where the earnings growth is going to come from in 2024 fiscal is broadly going to be technology, banks, and automobiles to some extent. And there is where you have even the valuation comfort. You have seen the massive correction in, let's say, the technology names, the banking names. But this is going to lead the mantle on the earnings growth front. So the biggest comfort comes from these sectors only. And obviously, since the valuations are comfortable on these sectors, these would tend to broadly outperform the high P stocks, or let's say the richly valued stocks. And since inflation is going to be headwind for the next 6-9 months going into FY24, I would believe that there's going to be again concerns on margin pressures, as far as things are concerned. So I think, one should focus on how the valuations shape up in individual names and in these sectors, and there is where the relative performance is going to come from.
All right, Manish, just to clarify on that point, do you believe that it's a good time to get into IT? Because, when we were chatting last, you were saying it's giving signs that it's bottoming out. So good time to get into IT? If yes, will you get into the large cap names or the mid cap?
See, I think within the next 2 quarters, I would believe that mostly all the negatives of the IT names would get priced in. It's a great time to buy IT, when particularly the sector has seen some very decent correction over the last 1.5 years. And, there is absolutely no interest. So the sector is seeing a lot of disbelief as far as the earnings growth trajectory on FY24 numbers are concerned. So, I would believe the sector would broadly see a high single-digit sort of constant currency growth in FY24, and again back to double-digit constant currency growth in FY25. Margins are going to be accretive from where we were in 2023 fiscal, and cross-currency, which was a headwind in FY23, will likely become a tailwind going into FY24 and 25. So from that point of view, I would believe both IT and pharma are great buys at current levels.
Manish, we had S. Narain of ICICI Approved yesterday. You mentioned that you expect value as a style or as a group of stocks to do better than growth. He left us with the thought that, and he's a contrarian, a little, early. He said value is done very well, and now we are watching for signs that growth starts to pick up. I mean, as a style, as a group, starts to pick up. Maybe now is the time to start getting in when things are still looking pretty bad for that segment. I don't know how you think about that.
So I think, the whole point is that if inflation is going to be a concern on margins and obviously the headwinds coming out of Western world in terms of corporate defaults, etc., how growth style is going to be in focus for the next 6-9 months remains a challenge. And I would believe that is continuation of the value style, which is likely to, be in focus for the next 6-9 months at least. And it all boils down to how the earnings trajectory in FY24 on the benchmark Nifty is likely to shape up. Every year we start with a 20% assumption on growth, and then it gets boiled down to, let's say, 10 to 12%. Even for fiscal 23, started with 20% earnings growth, but it will boil down to 12-13%. So I would believe it's going to be the value style which is going to continue in focus. Commodities might make a comeback thanks to inflationary pressures. This is one ignored sector, totally ignored sector, but this could have a repercussion on the high P names, particularly the consumption.
Manish, why are people selling banks so much? I mean, we know that there's no connection whatsoever between global issues and India. Is it just undoing yesteryear's or last year's great performance? Or is there anything else that comes to mind? And how are you approaching it? Because there's a severe correction. PSU banking index is down 14-15% this year. Bank Nifty itself is down 7.5%. Are you using the dips to buy more, or is it time to sort of lighten position, you'd say, and take profits?
No, so growth is not going to be the same as we saw in 22 and 23. Margin compression will happen because deposit rates are going to move higher as we move into Q1. And valuations, at least the known large cap private sector as well as State Bank of India, are broadly full. That is why, since a very heavy weight on the index, people move to the PSU bank. But now they have their own set of challenges in terms of shoring up capital, etc. So we have seen some broad correction. I think, it's got to do with the overall ownership of the sector that we are seeing in spite of decent earnings growth over the last 1-2 years. We have seen some massive correction out here. But I think even if we assume a trajectory of, let's say, 15% sort of earnings growth, not those 40-50% earnings growth that we have seen in 2023, valuations have become even more sanguine. And with the passage of time, the valuations are only going to become cheaper because growth starts to get priced in for fiscal 24 and 25. So, I would believe it's likely to remain an overweight sector for FY24 at least, even though earnings trajectory would be not as strong as we've seen in fiscal 23, but still it's going to be very decent and in line with or slightly better than what the total index, which is Nifty 50 earnings growth, is likely to shape up for fiscal 24. So I would broadly be a buyer on dips in the banking space, but more so on the private sector banking names as opposed to PSU names. In the PSU names, only State Bank of India.
All right. Manish, you were daring enough, so to call it, that you like something that one of these new age companies, Zomato, that was falling. But you said most of the bad news is in the price, but you're also studying other companies from the new age teams. Case in point, maybe the Paytms of the world. Are you still interested in that space? Is there one of those companies that are still looking up besides Zomato?
100%. So both Paytm and Zomato continues to be, our names that we have in our funds, etc. And we continue to like those names, given the growth, trajectory and visibility of profitability, both for Zomato and Paytm. And obviously, sometime into FY25, we are also likely to see positive PAT. As we see things, given the growth in both these names. So we continue to like them. And if we see further dip in the prices of these two stocks, we'll be happy to buy them even more.
Okay. All right, Manish, then we will wrap up the conversation today on that note. Thank you very much. Always great getting some perspective with you on the markets and a lot of the sectors that are, of course, catching the eye. That is Manish Sonthalia. The markets are holding on to a cut of about, I think, 0.5%, just a little over 0.5%, 1991 points. And that's the kind of market that we have, at least for the time being. Let's focus on some big developments in the oil and gas space, specifically this tariff revision that came in for GAIL. GAIL will be implementing the integrated natural gas pipeline tariff of just a little over 58 rupees, 58.61 per MMBTU. This new tariff is 45% higher than the current rate, and it comes into effect from the 1st of April. Two major city gas distribution companies, IGL and MGL, are now joining in to talk about the impact and, of course, their own business. We have with us Mr. Pawan Kumar, Director Commercial at IGL, and Ashu Shingal, Managing Director at MGL, both of us. Both of you, thank you very much, gentlemen, for being with us on the show this morning. So first things first, we just want to understand the impact of this tariff hike. Mr. Shingal, you go first. Now, actually, GAIL had asked for an even higher tariff. I think they were rooting for 68 rupees per MMBTU. It's 10 rupees lower than that. But what does it immediately mean for consumers like yourselves?
Good morning, everyone. It's a good move by the government of India because the unified tariff as such will be beneficial for the industry and it will reduce the location advantage or disadvantage to any industry. So although, as you mentioned, GAIL asked for 68, but yesterday's order of PNGRB is speaking about 58. So the impact will be that if a customer has to get gas from, say, Kochi to Assam, after the pipeline is ready, they can almost get it at par with the Zone 3 tariff or whatever zones are decided by the PNGRB. For MGL, it will be, for some customer, it will be a gain. For some customer, it will be a loss, depending on where they are situated. Suppose if they are using lines from two pipeline networks, currently they are being added. But with this integrated and subsequently unified tariff, it will be determined by single zone. So we take it as a positive steps, both in terms of new customers being set up and also for MGL. We are yet to receive what will be the unified tariff, and then we will compare it with our current tariff and see where we stand with it. But you said,
Mr. Shingle,
we are very positive about this step.
But Mr. Shingle, I heard you say that for some customers, it will get expensive, while for others, it might not have much of an impact. So is it going to be a total pass-through? Will you be passing it on to the end customer? Therefore, no margin impact for MGL?
Yeah, it will definitely be a pass-through, because tariff, there are two ways to look at it. One is that some of the gas we consume for internal consumption. So that has to be consumed by us. For some which we can pass through, this is a sustainable, continual basis. So we can't keep it on our books. It has to be passed through. If it increases, we have to pass through. If it decreases, we have to pass through.
Okay. All right. Let's get in Mr. Kumar as well into this conversation. Mr. Kumar, what about for IGL? What would the potential impact be?
Yeah, good morning, everybody. Though we are also yet to receive the final impact on IGL, but our preliminary analysis reveals that the input gas cost will go up by say 80 to 85 paise per SCM. And we don't have immediate plans to pass it on to the consumers, because we have not increased the prices for long in the past. We will review these prices as and when Krit Pari Committee recommendations gets implemented.
So good morning, gentlemen, to both of you, Mr. Singhal and Mr. Kumar. Mr. Kumar, so you're saying you will hold back?
For the time being. For the time being only. Yeah.
Right. And in your assessment, what is the, for me as a consumer, what is the impact going to be? If you were to pass through approximately, broadly, in percentage terms,
per SCM.
In percentage terms, what would that be?
Maybe in case of CNG, might be 1 rupee per kg.
1 rupee per kg. Does that, Mr. Singhal, in the ballpark sound correct? Does it seem okay to you?
Yeah, I think we are yet to receive the numbers from PNGRB, but it seems 1 rupees per kg per MMBTU per kg in CNG terms is perfectly okay.
Okay.
But as Mr. Pawan said, that it depends on on 1st of April, Kirit Parikh committee is also expected to roll in. So we will see price revision with effect from 1st April, because these tariffs are also applicable from 1st of April.
What about PNG, Mr. Singhal?
PNG will be having minimal impact. It is currently 54 rupees per SCM. So around 50 paise or 60 paise per SCM. We have to do the fine calculation once we know the tariff.
Okay. Just to go back to you, Mr. Kumar, you're deciding to hold this hike as of now. How does it play out? Since you mentioned the Kirit Parikh recommendations coming into play, what is the base case expectation that you're going with? And if you do not pass it on, then how much is the margin hit we're talking about with this 1 rupee that you will absorb?
See, I am saying that we will be reviewing the pricing once the Kirit Parikh committee recommendations are in place. So, and most likely these are to be in place from 1st April. So our review will take place after that.
Okay.
There will be some reduction in the input gas cost, and whatever increase is there on account of this increased tariff, that will account how much we are passing on to the consumers.
So we're waiting for April then to understand how much will it come down by. But what are you baking in, Mr. Kumar? How much lower could it fall?
In case PNG, this Parikh committee recommendations are implemented as recommended, I think there will be reduction of around 1.5 dollar per MMBTU if we consider the mix of RLNG and APM, non-APM both.
Okay.
And that will offset. Then, you're saying that will then offset this pipeline tariff increase.
Not the entire. See, that will be the net reduction, but how much is to be, passed on, that will be decided then and there. But in terms of the increased tariff, it will be there will be annual impact of around 200 to 250 crore.
Okay, so when you say that there will be an impact, you're saying, now this is going to be your discretion, whether then after the Kirit Parikh committee recommendations are public and they come in effect, then you will have to decide whether you want to absorb this 200 to 250 crore impact or whether you will pass it on. Have you come to that decision?
Then we will review.
Okay. Mr. Shinghal, comment on this. I mean, it's very clear that the next big marker for pricing obviously is the 1st of April when the recommendations come into play. What expectations are you going with respect to what the new regime will announce and will be like?
See, these are good times for the industry as well as positive for customers also, because there are two developments happening. One, that the unification of tariff is happening, which is in the long term good for the industry. And for CGD in specific, if Kirit Parikh committee recommendation is accepted as they are recommended, it is a good sign, as Mr. Pawan said, that maybe $1.50 to $2 per MMBTU reduction will be there, which will be passed on to the customer to a great extent. We will have to overall see the profitability, the alternate fuel cost, and then a final decision will be taken. But definitely 1st April is the cutoff date in whatever happens with respect to the unification of the tariff as well as the Kirit Parikh or the gas procurement cost reductions. We will take a view on that date.
Okay, all right. So we'll wait by then in April, and we'll invite both of you all to join us again to talk about that. But Mr. Kumar, before we let you go, you'll have also announced a JV, IGL and BHEL, for development, manufacturing and deployment of Type 4 cylinders, hydrogen, for hydrogen blending in the city gas distribution and fuel cell-based power backup system. What is the capex that will be going in there, and what is the potential that you're looking at?
Actually, we are just collaborating with BHEL. BHU is a Maharatna PSU, and they have got some land allotted in Banaras. So we are just exploring the opportunity, whether we can manufacture something in India as a Make in India initiative to make the country Atmanirbhar. So the things are at the initial stage. Working groups have been formed, and they will decide and finalize how do we go further.
Okay, we'll have you both back, of course, at your convenience after April once we have the Kirit Parikh committee reports. Mr. Kumar, Mr. Singhal, thank you very much for joining us with that perspective. 78 points lower on the Nifty. We were down 1995, so there is a 20-point pullback so far. 17,072 is where we are at. Just taking stock of the market. We are back with Vinod Agarwal, Managing Director and Chief Executive Officer at Volvo Commercial Vehicles at Eicher Motors, to discuss the business outlook and demand environment which they are seeing. Stay with us. We're back.